Welcome back, everyone. Today on the Joseph Carlson Show, we finally got into that part in the cycle where everyone starts to say that the market's looking a little expensive, that stock prices have gone up a bit too much. We have JP Morgan, for example, sending their representatives now saying that the market's acting a bit irrational and we should price this in. As we look at stock prices going up and companies becoming more expensive, how do we react as investors? We'll be discussing that today. Now, of course, we have a lot of other news to get to. For example, ASML is now above $1,000 per share. The stock is surging upwards above 40% year to date. We'll be looking at that and what to do now. Elon Musk is at an all-out war against Netflix, trying to kill the company. He in fact said that he canceled his Netflix account. He's encouraging everyone else to do the same. There's thousands, even maybe millions of people canceling Netflix. What do I think of this as a Netflix shareholder? We'll be going over that. We have Microsoft also upsetting a lot of people with a staggering price increase of their Microsoft Game Pass, changing it from $19 to $29 per month. And we have FICO making some big movements in the mortgage market. This has caused FICO stock to race up 20%. While other companies like Equifax and the other credit bureaus have gone down. And then finally, we have Peter Lynch going on a rare interview and sharing some of his timeless wisdom. We'll be looking at Peter Lynch, who I believe is one of the best investors, if not the best one to ever live. He hasn't worked quite as long as Buffett, but he has had staggering results over the time period he was an investor. And he's been somebody that I really respect, so we'll be looking at some of the wisdom that he shares even to this day. So we have a lot to get to in this episode. Let's go ahead and jump in. Now, before we jump in, just a quick mention. It's the 3rd of the month, which means if you haven't tried out Qualtrim, you can do so today. You join it by joining the Patreon. The Patreon gives you access to exclusive episodes, the Discord community, lots of different content and investors to talk to on a daily basis, as well as Qualtrim included. All of that, everything for $10 per month, and you get a free trial. The reason that I give a month-long free trial is because I'm convinced if you try it out, you'll like it. We have literally 10,000 plus people using it. It's climbing towards 11,000 now. And it's very simple. You plug in a company, you see the latest news on the company. It's all AI summarized. Then you see all the financials and beautiful visuals. It loads fast and we have custom KPIs. In Microsoft, we have the cloud backlog. On top of that, we have AI summaries of the strengths and weaknesses of a company. There's advanced watch list functionality showing you which companies are in a dip and which ones are in a stock price surge. There's a powerful earnings calendar that shows you every single week which companies are reporting earnings before market open and after market close, and you get the entire history. Every earnings call, we give you the full transcript as well as an AI summary, breaking everything down by topic to save you time when reading through your companies. There's a DCF calculator that's super easy to use. You can put in simple assumptions and see how a stock will trade over time. And then there's an entire portfolio management page where you can see all your holdings. You can combine different portfolios together and do all sorts of different things. Qualtrim is a product that I've worked on for a long time. I've built it specifically for my viewers and investors like me, and I hope you try it out. Now, moving on, we get to this interview here, and this is from someone from JP Morgan that is trying to warn us about the situation the market is in today.
But where we are is an economy which is growing more slowly. It's heating up in terms of inflation, and the outlook, of course, is just getting cloudier and cloudier as we lack these government data. So from a market perspective, I am a little bit concerned here because the market is just blindly moving higher when really a lot of the fundamentals are deteriorating beneath it. And so I think investors need to be cautious here and recognize that there is clearly a disconnect between market euphoria and really some growing problems in the economy.
So JP Morgan's global strategist here is saying that the economy is actually slowing down, inflation's picking up, and the market doesn't seem to care. Instead of pricing in these new warning signs from the economy, the market continues to surge up to all-time highs, moving into the category of all-time highs today. So why is the market ignoring all this economic data? Why does it continue to go up?
Well, I think there's a sort of structural imbalance in the market. I mean, first of all, the vast majority of people putting money into the market are upper income individuals here and around the world. And so they're doing okay because of, the economy is doing okay for them, and they've also got, huge wealth gains. So they don't feel badly about putting money in, but also people have huge embedded capital gains. So it's very hard to pull money out. So it's sort of this valve which lets money in but doesn't let it out. And I think the longer this bull market goes on, the more painful it is from a tax perspective to get money out. So there's sort of a disconnect here, which could only be broken by a real shock to the economy. So if people are really scared about a recession or a huge credit event or some other huge event, then you get a gap down in the market, and that could be very painful. But for investors, you never know the hour nor the day when such a thing could happen. So I think it's just best to play it on the safe side and recognize that there is something a little irrational about how high the market is going and how well it is doing given this uncertainty.
He calls the market, which is a name for just investors. Investors are irrationally bidding up the market and not paying attention to how poorly the economy is doing. He also tries to dissect the economy into two different categories, and we've heard this a lot before. There's the wealthier half, the haves, the people that are invested, that have stable jobs, gainfully employed, they're making money, they're funneling that money into assets, or they already own assets, they're doing quite well. All the inflation that's happening trickles up into their assets. Then you have the people that are just trying to make it by, they're getting by paycheck, and they're not doing so well. They're seeing asset prices inflate, they're seeing other things inflate, the cost of goods inflate, and meanwhile, they're just trying to make it by day. And this is why I believe, and I encourage everyone from every wealth group to try to get some money in the market. You have to get started. You have to start depositing money into a brokerage and buying assets. Now, this dichotomy in particular, I just want to say a couple things about. The whole idea that there's two different classes of people, ones that own assets and ones that don't own assets, is absolutely true. And at some point in another, in most people's lives, they're in the part where they don't own anything. I was in that part as well. I had a part of my life where the only thing I owned was $2,000 in a checking account. I was working a job making $12.50 working customer service. So we've been there before. The goal is to transition from that category into an asset owner. And the only way that I know how to do that is just by continually putting money from your paychecks into assets. You have to do it. Now, the bright side is that anybody can do this at any point in time. You have Robinhood, you have M1 Finance. Every brokerage offers free trades. If you have no money whatsoever in any assets, it's difficult at this point to blame anyone other than yourselves. And that's just the reality. If you can hold a job and remain gainfully employed for any length of time, some of your paycheck should go into assets. So while it's true that he's saying that there's this dichotomy that's existed between these two different classes, that dichotomy always exists. But now there's more tools than ever for people to move from one end to the other. The other thing that he mentions is that he's saying that a lot of people just have so much gains that they're not taking their money out. I don't buy that excuse as much. I think if people truly thought they're going to lose money in the stock market, they would take their money out and pay capital gains tax. I think part of the reason people keep their money in is because it's done so well for so long. People know, and I think investors are smart enough to know, that people like this have been warning about the market crashing every single year for the past 10 years. We've had these so-called experts from JP Morgan become overly bearish on the market because of some indicators that they have. Meanwhile, it's proven that they don't know much. Remember when JP Morgan's Marko Kolanovic has been bearish on the market for year after year, saying that all the valuations don't make sense and investors don't know what they're doing, they should stay out of the market. And he was so wrong. In fact, he was so wrong that JP Morgan had to fire him. So he lost his job by pointing out the irrationality of investors and being proven wrong time and time again. The economy grew faster than expected. Assets went up in price faster than expected. Big tech grew earnings faster than expected. All the so-called experts, like we're seeing here, ended up being wrong like they have been many times in the past. All these so-called experts that are saying that investors are once again irrational have been proven wrong time and time again. And rather than having some self-reflection and saying, you know what, I think the reason that investors continue to bid up stocks is simply because most people have been bearish on them. They've kind of given gloomy views in the past and they've been proven wrong. And these companies are fantastic, they're growing earnings, and even if they're a little bit overvalued, there's nothing else better that investors can do with their money. Instead of giving that perspective, he blames the investor. He blames you and me for remaining invested, even though we're not looking at the economic growth and the GDP projections and the inflation metrics. It's our fault for keeping our money in the market despite these indicators. The problem with simply selling all your winners and moving to lower quality companies outside of the United States or foreign companies that don't have as strong fundamentals is in many cases you end up just having worse returns overall. What I've seen time and time again is holding a portfolio of high quality compounding machines is the most predictable way to have excess returns. When I look at the type of companies that I own, it would be easy to look at the ones that have done really well and simply say, now that they've done really well, I'm going to sell out of them. Like ASML. This stock has done incredibly well. It is now one of my best performers in the portfolio. Now, when I look at ASML, I'm up $27,000 on this company. It's a $27,300 gain, 50% time-weighted returns, and I first started buying this company this January. So the CAGR on this one is 60% in a single year. It's one of the best performing stocks I've ever bought in my portfolio. And I have decisions to make on this one, whether or not I buy more, or I trim it, or I completely sell out of it, or I just continue to hold. Investors are continually faced with these decisions. Whenever I have a stock like this that's run up in price in a short amount of time, I usually lean towards just holding it. In some cases, I might take a little bit off the table, I might trim it, but in most cases, I found that's a mistake. Stocks like ASML go on these fantastic runs because fundamentally they're improving. In this case, we have ASML having more incremental demand with their EUV machines. Now they have the high NA EUV machines. These are like even better EUV machines than they already have. It's really incredible what they're doing. It is a true monopoly, and it's still selling at a 30 PE. Companies that are real monopolies typically sell for higher prices, but ASML is growing quickly and they have increased demand. And in terms of the overall economy, I don't factor that into any of the investment decisions I'm making. At any point, the economy could turn south, and that's a reality that investors have to know anytime they own stocks. Every single stock we own, we should own it knowing that the economy could go south. Whether or not you own a restaurant or a vacation property, whether or not you own Costco or defensive companies like Netflix, all of these companies should be owned with the possibility of a recession, with the possibility of a bear market. I own these companies knowing that that may happen once around every 7 years, and it's just a part of the game. Now, it's not the only investing strategy. There's lots of ways to make money in the market, but I still firmly believe the best strategy for investors, proven time and time again by almost every example, from Phil Fisher to Benjamin Graham to Warren Buffett and Charlie Munger, is to hold a portfolio of high quality compounding machines, companies that have long durations of growth. You can invest in them once and hold them for a lifetime. Companies like Coca-Cola, companies like See's Candy, companies like Geico, ones that you simply buy and they just generate excess cash year in and year out. When you have a portfolio of those, not every stock will do well, and they never did in Benjamin Graham's portfolio or Phil Fisher's. They haven't in Warren Buffett's or Charlie Munger's. All of those investors have had losers, but overall, the entire portfolio should compound at an intrinsic rate that's very high, especially if these companies are growing their free cash flow per share and they're growing their earnings per share. So I own these companies. I continue to own them so long as the quality is high, the valuation is reasonable, and the companies will continue to generate excess returns in the future. And in terms of the people from JP Morgan saying that retail investors like you and me are irrational for staying in the market, I don't believe there's anything less rational. I believe everybody should have as much assets in the market at all times as they can. And the least rational thing you can do, which has been proven time and time again, is to try to time the market. Trying to take your money out because you're anticipating a sell-off in the market. That has been a losing strategy. So when we get to the end of this year, closing out 2025, you're going to hear chatter of the market being overvalued, that it's time to sell, that you should look for other investments and sell out of your greatest, best companies, and I believe that's a mistake. This same warning has been given for the past 3 years as the market's raced upwards. Investors have no clue about how the economy is going to do over the next 5 years. They have no clue of how AI is going to develop, what new technologies will develop, the type of gains that will develop. But what we do know is in almost every case, staying invested for the long term is the best decision. Now let's go ahead and move on to some news. Now, first up, we get to the breaking and evolving news of a new boycott against Netflix. This time it's being led by Elon Musk. He is waging all-out war against Netflix, telling hundreds of millions of people to cancel their Netflix accounts, encouraging them to do so right now, fighting against the alleged woke bias in kids shows and LGBTQ shows. Now, before we jump into Variety's context of this and their version of it, I just want to lay out the facts of how this evolved, the timeline of events. This all started with an account on X called Libs of TikTok. It is a prominent political account that has millions of followers. The Libs of TikTok account posted a clip of a show from Netflix that was canceled 2 years ago. The show is called Dead End, and it features a trans character and is pro-trans messaging. The show is also directed towards children, youth of 7 years old or above. Now, this clip that was featured on the Libs of TikTok account went viral. And Elon Musk made it far more viral by retweeting it and stating that Netflix is coming for your kids. Look at this clip. To add to that, soon after this clip went viral, after Elon Musk retweeted it, it was also revealed that the creator of this show is a Netflix employee that celebrated or at least justified the killing of Charlie Kirk by calling him a Nazi. And obviously this outraged millions of people. Now there's screenshots. There's people sharing that they're canceling their Netflix account out of outrage for this employee, his comments about Charlie Kirk, and out of outrage of trans messaging being directed at children. Tens of thousands, maybe hundreds of thousands, if not millions of people at this point have canceled. Now, before I go on with the timeline of events and how I view this as a Netflix investor, I first want to point out that I have no problem with people being outraged about this. Frankly, the comments from this employee about Charlie Kirk are despicable and vile. The employee should be looked at as a huge liability, someone that's costing Netflix hundreds of millions of dollars, not an asset to the company. And I don't have any problem against people that vote with their feet, that vote with their wallet. That's how capitalism works. If you like a product, you can pay for it. If they do things you don't like, you don't have to pay for it. And I have no problem, no judgment against people doing that at all. But I also want to view this from an investor perspective. I am invested in Netflix. I think overall, all things taken into account, it is an incredibly good company that I think will continue to do well in the future for a couple of reasons. One of them is when we look at the problems that Netflix is facing today, many of them stem from the fact that Netflix is simply so big. It's so big. The company is just so massive. They have so many subscribers. They have so much content. Their library is so massive that it makes it the biggest target. And that's the problem with being the biggest company. When we look at Netflix, this is a company that has 16,000 plus titles in its library at any given time. Not to mention they're spending nearly $20 billion per year on content every single year. When you spend $17 to $20 billion a year on content, when you have 16,000 titles, you can almost find anything you're looking for in any category. And while it's true that Netflix has a lot of woke content or LGBT messaging in their content, that is part of being a massive streaming platform. And every massive streaming platform has the same issue. YouTube has lots of content of every category, even for children. You can find woke content, LGBT content on YouTube without a doubt. There are millions of hours of content on YouTube uploaded every single day, almost every single hour. YouTube could restrict certain contents, they could create guidelines for it, but they allow a variety of content as well. And you'll find the same thing to the scale of Paramount Plus or Amazon Prime Video. All of these companies have a variety of content that doesn't represent the values of every single one of their viewers. And again, while it's true that Netflix has a lot of woke content on it, it's also true that they have a lot of non-woke content on it, and even content that's Christian related. One of the most promoted shows on Netflix is called The Star, one about the nativity, the telling of Jesus Christ's birth. One of the most popular series on Netflix for adults is The Chosen, a Christian show about the life and ministry of Christ. These are very non-woke things being on Netflix. Netflix isn't banning Christian content. They're not banning comedians that make fun of woke things. They have Dave Chappelle on it. They show a variety of content from all different perspectives. So while I believe it's okay to protest it and to push back against content you don't like, I also think that Netflix faces a problem of trying to serve too many different audiences at the same time. And I believe one of the solutions that may come from this is better categorization, better labeling of the content, so parents can be sure of what their kids are watching. Right now, having all this different content mixed together in the same pool without controls and labels to categorize and be able to filter out what you want to watch, I believe is the biggest problem. So when I look at Netflix today, I believe it faces many of the challenges that any large video streaming platform faces. That it's going to have content upsetting to certain groups of people. They'll protest and boycott as a result. And I think that that can alter the business over time. I think it does inform Netflix to some degree. I think these protests are likely somewhat effective. They probably make them think twice about making certain decisions. So I'm not entirely against the protesting. I'm not entirely against the pushing back on this. But I think it's something that you have to take into account if you invest in any large streaming platform. We've also had massive boycotts a time ago for YouTube, for very specific reasons. There were millions of people upset about YouTube as well, and they changed their policies as a result. So hopefully Netflix can learn from this, they can evolve, and we can have better categorization and controls for our kids' content. We can know as parents what they're going to view before they view it. Now, in terms of how Netflix reacts to this, what they do as a management team, and how the stock reacts, I think there's a couple things we can look at. First of all, Netflix has declined to comment on this controversy. So Netflix continues to just completely ignore it, at least publicly. But internally, they're certainly not ignoring this. They're looking at it. And the reason that I believe that they ignore it publicly is for a specific strategy. If Netflix were to give in and say, hey, we're firing this employee, we're changing all of our content, we're going to make this all right for all of you, what that does is emboldens the mob. It tells the mob, your protests are working. Look at how effective they are. Protest more, cancel more. That would be direct signaling that what this mob is doing is working, and we need to do more of it. So Netflix is not going to comment saying how effective the mob is and how they're going to change everything in their business as a result of it. I think that's a very basic strategy. But internally, Netflix is looking at this, learning from it, and they're going to adapt as a result. We can also look at the stock price here. The stock of Netflix has come down a little bit, but it's still a massive position. I have it as a $133,000 holding, $80,000 in the green. And we look at the stock price, it's down to $1,159. Now, looking at Netflix stock, it's up 30% year to date. It was in a bit of a downtrend prior to this boycott to begin with, and this brought it down a couple percentage points. This is not a big move. Not a big move so far. So far, it seems like Netflix investors aren't too concerned about it, and I believe for good reason. In most cases, when you have boycotts like this for media, typically it only lasts a certain amount of time. We saw the same thing with cuties. We saw the same thing with the password crackdown. We saw the same thing many times in the past with Netflix, and the boycotts have just resulted in the stock price going up in the next 5 years. And I believe it will be the same case today. Many of the people canceling their Netflix very hastily after seeing these clips be resurfaced are going to be signing back up for Netflix when the next Stranger Things season comes out. We have the ending of Stranger Things, which is one of the most highly anticipated series to ever exist, ending this year. We also have 2 NFL games streamed exclusively on Netflix on Christmas Day. Many people that have canceled their account are going to be signing back up for it once again. And we've seen this before. Many of the big accounts on X that are canceling their Netflix account in protest have done so time and time again. Every protest, they've canceled their Netflix account. Like Wall Street Mav, that canceled Netflix in 2023. Then he was upset about something else and canceled his Netflix account in May 30th of 2024. Then he was upset again at this whole debacle, and he canceled his account again in October of this year. So we have 3 cancellations from the same guy, and the next protest, you better believe he's going to cancel his Netflix account for the 4th time. The truth is that Netflix is at a point now where it's very difficult to avoid for a long period of time. And many of the people that are canceling today will be back at Netflix when they have a live event or a show or something they want to watch in the future that they can't find anywhere else. Now, next up, we get to another company that has upset a lot of people for a different reason. In this case, Microsoft is raising the price of Xbox Game Pass Ultimate. That is a subscription where you get like all these games included. Microsoft is basically making it so you kind of have to buy that to really enjoy the Xbox. And they're raising the price of the Ultimate, which is the best plan, from $20 per month to $30 per month, a 50% price increase. And they're attempting to justify this price increase with a variety of upgrades. More than anything, this shows the power of Microsoft. They can just bump the price of one of their products up 50%. And yes, you're going to have some churn. Some people will go and cancel their service, but most people, again, will come back to these services because there's very little alternative. Microsoft stock is up today after this announcement, even though people are furious about this. And it's the case with Microsoft since its history. They can bundle things together, they can raise prices, and people don't have many other places to go. You can go to PlayStation, but again, you're going to be paying for the same thing. You'll be paying per game or paying a license to use games over time. So Microsoft is just, once again, flexing their pricing power. In this case, I don't think it's going to damage the company at all. Most people that love gaming will continue to pay for it. Now, finally, we have news of FICO. This stock had a big jump. Just a day ago, it went up 18%, around 20%, and then it's up another 4% today. And that is on the news that FICO is now going direct to consumer. Here's the CEO of FICO explaining the move and how it's beneficial for the company.
We're in a quiet period, so I can't I can't speak to, next year's numbers, guidance, forecast, but I would tell you that this is good for FICO, yes.
This is incrementally a great development for FICO and a bad development for Equifax, TransUnion, and Experian. The way that FICO scores work is they take the data from the credit bureaus. They take all this data that the credit bureaus have, they map it together, they create an algorithm, and then that algorithm is the FICO score. And then the credit bureaus, working with the banks and working with the lenders, they sell that FICO score as part of their overall package. So FICO's not directly reaching out to the banks and selling their FICO score. They're going through the credit bureaus, through the tri-merge, and that's where they include the cost of the credit score. Equifax and other companies like it, the credit bureaus, have been selling the FICO score with a bit of a markup. That markup is almost 100% profits because they're basically just taking the FICO score, distributing it, and then selling it for a bit more for a profit. And that's been the business case for the past decade. They've grown very rich doing the same thing over and over again. And what this does is shift it from FICO going through the credit bureaus to now selling direct to the banks. Now, they're still relying on Equifax, TransUnion, and Experian for the data. FICO still needs the credit bureaus in that case, but they don't need them for the distribution. They're saying instead of going through the credit bureaus and having that small markup, you can go directly to FICO with our direct-to-customer experience. And that way you save a bit of money. In fact, you save about half because you're not getting the markup from the credit bureaus. And what this does is enhance the scale, enhance the direct-to-consumer relationship between FICO. It circumvents it for the credit bureaus. It puts them in the place of a data provider, not a company that has that direct-to-consumer relationship. But this is incrementally negative news for Equifax. There's no way to spin it. There's no way to look at this in a positive light. All this does is force Equifax to contend with the fact that FICO is going to be bypassing them to some degree, that FICO will be having the direct relationship with the customer, and neither of those things are good. I like when companies have direct relationships with customers. I like when Netflix has it with their customers. I like when Spotify has it with their customers. And I'd rather be the owner of a Spotify that has the direct relationship with the customers than the owner of a Universal Music Group that has to go through a Spotify. I believe the company that has that direct relationship is in a much better position. So with FICO, what they're doing by bypassing the credit bureaus and going direct to the banks is they're creating a new direct-to-customer relationship, that more advantageous experience, where FICO can now offer more upsells and cross-sells, and they don't have to go through a distribution partner. That is a very enviable situation to be in. Equifax now has to contend with the fact that they're losing that direct-to-customer experience, or at least to some degree they're being bypassed. And that's an incrementally negative development for the company. So I believe in many cases stocks trade down for reasons that aren't good. They're invalid reasons. I believe that this is a real reason for the stock to go down. This will impact the future earnings of the company. It will impact the competitive nature of Equifax in terms of their credit bureau and their mortgage segment. But I also believe this isn't a kill shot for Equifax. In fact, it's not even close. The company has a lot of routes they can go. First of all, Equifax is already leaning into their verification services, which is the fastest growing portion of their business. And that has nothing to do with FICO or these credit scores to begin with. But on the subject of credit scoring, they could also lean in more to value-added services, make a more comprehensive offering than FICO, so that even if FICO has a cheaper price, they still want to go through Equifax. Many lenders will want that more comprehensive, know your customer approach. There's also VantageScore, which I believe the credit bureaus are going to be more inclined to push more aggressively now that FICO is directly competing with them. So while this is an incrementally negative impact on Equifax's fundamentals, I'm not out of the stock yet. I believe there is a chance they can have a game plan to evolve and even do better as a result of this. But I'll be paying attention to the next time management speaks about this, how they believe this will impact their future earnings, and if it's such a material impact or not. But as of right now, I'm still holding this company. Now, next up, we have comments from Peter Lynch that did a very rare interview. Peter Lynch is an investing legend. He's one of my favorite investors ever. In fact, he was the first investing book I've ever read, which was Beating the Street. I highly recommend that book. But here he is commenting on some of his thoughts, some of his quotes that he's done that are just legendary quotes. Let's go ahead and take a look at this one. The first one here is that more investors have lost money anticipating market declines than in the market decline themselves.
I think people, they're always worried the market's going down. And it does, as I mentioned.
He said that people are always worried that the market's going to run, and it does. So people they're worried that the market's going to go up, and it does go up.
And, 2 years ago, they were saying 2024 was going to be a down year for the economy, and 25 is going to be a down year. I mean,
every year.
I think economists have predicted 33 of the last 11 recessions.
Yes.
And
he gives no time for economists whatsoever. Peter Lynch is somewhat famous or infamous, however you want to look at it, for in part saying that if you spent 15 minutes looking at what an economist says, you've wasted 15 minutes, and he still has that same view. As he points out correctly, these people saying doomsday for the market, saying that things are overpriced, saying that the economy is going to go down, they said the very same thing this year. They said it in 2024, they said it in 2023, and they'll continue to say it in the future.
you look dumb in this business. You're terrific in this business. You write 6.5 times out of 10.
Yeah.
That's a great score.
Yeah.
Even if you rate 5 times out of 10, if you own Costco or Walmart or I can't even pronounce the video. I'm getting close to being able to pronounce it.
I think you nailed it just there.
But that offsets your mistakes.
Yeah.
You have to have these winners offset mistakes, and that's what we've done for 70 years at Fidelity.
He mentions there's something very important. As investors, we like to focus on the failures and the few companies that aren't going up with the rest of the portfolio. But he points out if you have 6 out of 10 of your companies doing well, that's an excellent record. Even 5 out of 10 doing well is great because those 5 can more than make up for the losers.
The real key to making money in stocks is not to get scared out of them. Why is that the key to making money in stocks?
Well, more important to that is I have this expression, know what you own. People,
I was going to do that one later. I'll cross it
but
off.
that's it. That's the most important lesson.
Okay.
Because you'll get shaken out if the stock goes from 10 to 8. You don't know what they're doing. What are you going to do with it? And
Now, he mentions that more important than not getting shaken out of stocks is simply knowing what you own, is because the only way that you don't get shaken out of a stock that's gone down 50% is if you really know what you own. If you just bought it on a whim or because someone else told you to buy it, you're going to lose your confidence in that stock. The sentiment will be so bad that you'll believe you made a mistake, you'll sell out at the bottom. So it's not just as simple as don't get shaken out of a stock, it's truly know the asset that you own. Know why they're going to grow earnings in the future, know why the developments in the future are going to be a better case for the stock. If you don't know what you own, you will get shaken out during volatility. Peter Lynch is just the best. He has the best stories. If you haven't read his books, pick up one of them. I think they're so worth reading, even to this day. Now that's going to be it for this episode. Hope you enjoyed. Have a good weekend and see you in the next one.